The market doesn't know what keeps you up at night. It doesn't know when you want to retire, and it doesn't know how old you are. The simple truth is, the market doesn't care. But if you care, you've tuned into the right place. You're listening to Investor Resources, bringing clarity to the confusing world of finance. Here are your hosts of Investor Resources, Don Creech and Perry Sykes.
Well, I'm Don Creech.
And I'm Perry Sykes, and welcome to the Investor Resources podcast.
So the market, well, what's the market? Let's be a little more specific. Certain indexes, the S&P 500 and the Dow Jones, have been setting new all-time highs in the month of February, no less, which is a month that seasonality suggests is a weak month, followed by another weak month being March. And that is causing some consternation among some of the people who tell us where the market is going to go. It can't go up because it's February. And yet, as the day we were recording this, the S&P and the Dow set new all-time highs, and the NASDAQ set a year-to-date high. They still have a ways to go to get to the all-time high back from 21. And the meme on the web is that just like last year, the only thing that's driving this is technology. It is we've abandoned the Magnificent Seven because Tesla's in the tank. Not that they have a tank to be in, but the stock price.
No tank involved. Right.
So we're now calling this, what is the new term for it? The sensational six. That's it. The sensational six is driving the market. And to some extent, that's certainly true. However, if they were absolutely dominant, the NASDAQ should be at all-time highs, and it is not.
Correct.
It's
just
year-to-date highs. So there is other activity that's going on in the market. There are other areas that are setting new highs for a particular sector or an industry, but that can be deceiving. I mean, one of the articles that you found, Perry, that brought to my attention was that it isn't just tech that's driving the market. There's a whole slew of other areas. If you do a deep enough dive, you will find there are new highs going on.
Correct. That's important. It's so important to remember that we always say don't invest in the narrative. Buy look at the data, buy facts. Don't worry about what the narrative is. The narrative is also oftentimes focused on an index, and so it's like, well, the only thing driving the major indexes are the Magnificent Seven, and it turns out if you take a look, not exactly the case. Doesn't mean they're not strong. They are, but it doesn't mean that's the only thing going on. And it's always important to do the work, dig in a little bit, see what else is doing well too, and see if the narrative is true that it's just that there's only you've got to be a mega cap tech stock or you're not doing well right now, and not actually the case right now.
No, that's not. In fact, in one of our portfolios, we are overweight in large cap stocks, and we're using some exchange traded funds that have exposure to the sensational six, but they're doing quite well and setting new highs on their own. But there are some discrepancies. One of the new highs is in value stocks. We do a Tuesday webinar with other advisors, and the issue is a format of what's working, where's leadership in the market. And so we look at different charts and consider them and say, does this make sense because of the momentum that seems to be building here? One of which comes to mind is value stocks or dividend stocks. Well, but when we look at them, it's always, well, maybe those particular ones are doing well, but how well are they doing compared to the S&P 500 or the ETF for it, the SPY?
Sure.
And what we found throughout this last Tuesday's session was it's really hard to find even something that's doing well, that's doing better than the SPY, the Dow, that you can find some things that are doing better than the NASDAQ. But if you go to the QQQ, which is the NASDAQ 100, and you rank it on recent performance, it's there's not that many things that are outperforming those three indices: the SPY, the triple Qs, and the DIA for diamonds, the Dow Jones. So yes, there's good news. You can go out and find something, and if you're buying individual stocks, you just do a deeper dive. You have to do a lot more work to find an individual stock. They are there.
Correct.
This
Yep.
this is not a bad news market. This is a market that's in transition from a bear market that was very devastating, both in terms of capital and in terms of sentiment, investor emotional response. And investors are slow to recover. It takes a while to finally decide the money that you took out probably at the bottom should go back in the market now that it's at all-time highs. And this is where we run into that FOMO acronym, a fear of missing out.
Happens a lot. And you know that the it can help you find a way back into the market, and it's important. It's important not to sit and watch a market that's doing well, and you get so afraid of it that you can't re-enter. And that's one of the problems with buy and hold investing, where you finally get up the gumption to sell something, and then it's like, well, I can't get back in. And like we always say, we follow the money. We're trend followers, and it'll give you that confidence to say, a couple of months ago we were overweight in small cap stocks. And that went for a month or two, and then it rotated back again and went back to large cap. So we went back to large cap. So it's not just a matter of owning an index and forgetting about it. There may be part of that index that's doing significantly better than some other part. And also, it's not doing as poorly when things go bad. And so it's kind of a double-edged punch for the upside there. You're not getting hurt as much in the downside, and you've got more upside if you're paying attention and not just saying, well, I'll just buy the index and forget about it. Especially, S&P 500, that's 500 securities, and you need to take a look at it and say, well, what part of it's doing well, and do I have to own the whole thing? And the answer is no, you don't. It's more work, it's more homework, it's more due diligence, but it's generally worthwhile, especially on the risk side. That's the best way to limit risk: buy things that are doing well, and you can avoid those things that are having a hard time with the economy. And the reason why doesn't really matter much. Just find things that are doing well.
Well, you raised actually two issues in those comments, one of which is the switch in small caps. I mean, small caps had
Yeah.
roughly 2 months of strong upward movement at the end of the year. And that was really predicated on the fact that interest rates, it wasn't a fact, predicated on the assumption that the Fed was going to cut interest rates 4, 5, 6, and some even 7
Right.
times this
Right.
year. And lower interest rates would make it easier for small companies to refinance their debt, get lower payment obligation, and make it easier for them to be profitable, because there's a whole slew of small cap companies that are not profitable. They
Correct.
survive, but they survive because they still can afford their line of credit. And if they can't afford it, they're basically out of business.
They're in trouble. Correct.
And
Yep.
when it became apparent that the Fed was not going to cut interest rates 6 times, well, all of a sudden, small caps are facing major hurdles again financially, and the stocks reversed. The stock values reversed. Sellers showed up; they dominated instead of buyers, and that actually remains a concern today, because the Fed and the various representatives of the Fed are out on the speaking circuit saying, it's just not time to raise it, not time to lower interest rates yet. We think that
Right.
inflation has to come down further. It needs to be persistently lower, because inflation's still higher than pre-COVID. I mean, it's come down off its high, but stuff is still more expensive than back when the administration started its office and its new policies.
Correct.
So
Correct.
when we look at those indexes making new highs, the large cap indexes, the triple Qs, the NASDAQ 100, the S&P 500 and the Dow Jones. At the same time, when we look at small caps and mid caps, they're losing pricing structure, they're losing momentum. That often happens at market peaks. It's not abnormal. We've seen this before. So while we are fully invested, we're very cautious about bad news that may show up, a catalyst that's unexpected. We don't, well, if the war, either one of the wars that are going on the other side of the world happen to explode, those
Oy,
would be bad news catalysts.
correct.
We end up with government shutdown, which is probably a benefit for all of us that we don't have government working for us.
That's just
But
our opinion, but yes, we do believe that's true. Yes, that's a good thing. So,
there could be a catalyst that causes all this stuff to go awry. And if that's the case, then the fact that the small and mid cap companies have been losing steam while the major indexes are going up. And this is not the first rodeo here. We are prepared to address that issue systematically. And if you haven't thought
sure.
about it and you're doing this on your own, you better start making a plan. If you don't have to use it, so much the better, but it's better to be prepared than to be blindsided on it.
Absolutely.
There,
That's what we always, you hear from us all the time. Follow the data, follow the money. And that's what we're talking about. If small cap is where it's at, that's where we want to be. When that changes, we need to move and you need to be paying attention and you need to be engaged enough to say, okay, it's time to make that move. We're still staying invested. Where we're invested is going to change. And that is going to be changed based on who's attracting cash. That's where you want to be. If there's a chance for an external shock that's going to hurt the market, which there always is, if you're where money is flowing in, that's going to get hit the least and it's going to usually get hit last. So it gives you a little more time to make a move. So again, it really helps on the risk side, but you have to be paying attention. You have to not just listen to the narrative from 40,000 feet. You have to drill down a little further and say, okay, where's a good place to be invested now, even if it's even after you've made the decision that it is a good idea to be invested now.
so one of the areas that you can watch is the volatility index, the VIX.
Yep.
Volatility, if we go back a few years into the prior decade, volatility was a big bet by traders. They were betting on falling volatility issues, and it works until it doesn't, and
It
then it
doesn't.
just
Right.
collapses and you get wiped out.
Right.
I don't remember. This has happened more than once. I don't remember which year it was, but I was following a trader who was selling his advice. It was a newsletter basically, and
Hmm.
it was trading the VIX. And one weekend, Credit Suisse was running that VIX at the time, and they ended up on the
Right.
wrong side of the trade. And over the weekend, they had to shut it down. And the
Right.
uh, the ETF had been trading something close to $100, and it opened up on Monday about 9 cents. I mean, it was they got about 90 cents when it finally liquidated. But that's a really big bet. That's very very risky. And unfortunately, that bet is back in play today. The VIX has been so low that the traders, the guys that bet big money on leverage, are back in the same game. And um, all we need to do is see some catalyst show up where the VIX accelerates, gets above 20, and all of a sudden those trades just basically collapse. And with that,
Disappear.
virtually everything else in the market is collapsing at the same time. It happens very, very rapidly. You mentioned that not buying the SPY, the entire S&P 500, and basically
Yeah.
we have decided just to do that. That the orientation we have while we own the S&P 500 and various components, we own the growth component as opposed to the entire thing, because the entire thing owns value, and value, as I said earlier, hasn't been doing all that well. If you have a choice, well, let's take leadership. Leadership, as long as leadership is working, that's where our portfolios are oriented. When it quits working, something else is. And so you rotate. And that's the difference between having a momentum strategy, a disciplined strategy to select and rotate and go to cash if need be, rather than broadly diversifying into a wide range of asset classes. Typically, that includes commodities, a little bit of commodities, some foreign markets, some emerging markets, maybe some frontier markets. But with a rising dollar, which happens when interest rates are rising or strong in the United States, it's a detriment to being invested in overseas without very careful selectivity. And that selectivity is a function of what's happening with the market and our investors plowing money into it to drive the prices higher. Emerging markets have been cratered of late because of the ongoing problems in China. They get one good day on this premise that the President Xi is going to give the bank, the People's Bank of China, permission to flood the market with money to encourage investors to buy Chinese stocks. Well, it doesn't last very long when Chinese investors don't trust the government with anything that they're doing. I mean,
Makes it hard. True.
It just came through 3 years of being shut in their apartments for all practical purposes, and not being able to spend or go or buy groceries. I mean, it's going to take a long time for China to turn around. So if you're tempted to the emerging markets are a bargain argument, be very, very careful. That it's not an area that a novice should be invested in. Anyway, I think we've covered quite a few things
We're
for
good.
people to think about, review what you're doing. And if you're not certain and you want some help, you can give us a call. The phone number follows on this next slide. We'll be glad to talk with you. Send us an email. We'll be glad to respond. And we have podcast, well, not only our podcast stuff, but we have webinars on our website at iriradio.com. Subscribe if you haven't already. If you have, thank you very much. Have a great week.